Hello, everybody, and welcome to this edition of Via Talks. Today, I am going to talk about a much spoken topic, especially in the financial markets, of a US government shutdown. Now, what exactly is a US government shutdown? If you look at in the US Constitution requires all the three branches of the federal government to be funded through the appropriations process in the United States Congress. All federal spending bills originate in the House of Representatives under the jurisdiction of the Committee on Appropriations. Now, since this appropriations process can be complicated, Appropriations Committee divides its work amongst 12 subcommittees, each of which is responsible for producing a bill that funds particular departments and areas of the government. Thus, there are 12 different spending bills to fund agencies across the government. Now, like any other bill or legislation, these spending measures must pass both houses of the Congress, that is, the lower house, which is the House of Representatives, and the upper house, the Senate, and then be signed by the President to become a law. The US Congress conducts the appropriations process annually, starting 1st October, which is also the start of a new fiscal year. Now, given the onerous process of passing these bills, which could also be quite time consuming, Congress can pass a continuing resolution or CR. This temporary funding allows the government to keep functioning in the interim before regular appropriation bills are passed. You can see more details from the House of Representatives archives in the link below. Millions of federal workers, including federal courts, military, including the Pentagon, pockets of law enforcement, museums, National Zoo, health services, Department of Education, segments of childcare, agriculture, labor activities, and indeed the White House staff. The impact could be on workers being furloughed or not being paid while continuing to deliver on their duties. Most importantly, lawmakers continue to collect paychecks. And yes, staff deemed essential would be required to work, though they will not get paid unless a specific bill is passed to fund them for those work hours. As per the House of Representatives archives, there have been 20 instances of funding gaps that have lasted at least one full day. Now, for the records, Ronald Reagan's tenure had a record 8 government shutdowns during the 80s. During Donald Trump's tenure in late 2018, the most recent government shutdown was also the longest one at 34 days. On average, shutdowns have been resolved in 8 days, with some lasting only for a day. Loan approval is impacted for small businesses through the Small Business Administration and home buyers through the Federal Housing Administration. Both of these are federal agencies, and hence the impact that comes in, which does have an impact on the economy, some segments of the economy, and also a bit on the housing market as well. A shutdown also puts a question mark on the government's ability to pay its debts, which could lead to a sell off in the government bonds or the treasuries, as we call them, further causing rates to rise. Do note though, even after a cut to its AAA ratings, the US government debt continues to be perceived as a risk free asset. And I'll not be surprised if even during a shutdown you actually see the rates remaining stagnant because money moving towards a risk free asset. What about the regulators? The SEC, the Securities and Exchange Commission, and the Commodities and Futures Trading Commission, the CFTC, would furlough most of its staff. The Fed, the Federal Deposit Insurance Corporation, and the Office of the Comptroller of the Currency would continue as usual. since industry fees rather than congressional appropriations fund them. During the shutdowns, the collection of economic data also gets impacted. Employment reports, except for the ADP employment report, which is privately funded, inflation readings, and measurement of GDP is impacted as well. As per Goldman Sachs and JP Morgan estimates, a government shutdown would reduce economic activity by 0.2% as per Goldman Sachs and 0.1% as per JP Morgan every week that a shutdown lasted. Though you would see growth would then bounce back after the government reopens. As per the Congressional Budget Office estimates CBO, due to the shutdown in 2018-2019, real gross domestic product GDP in the fourth quarter of 2018 was reduced by $3 billion in relation to what it would have been. In the first quarter of 2019, the level of real GDP is estimated to be $8 billion lower than it would have been. It's an effect reflecting both the 5 week partial shutdown and also the resumption in economic activity once the funding resumed towards late January. As a share of quarterly GDP, the real GDP, the level of real GDP in the fourth quarter of 2018 was reduced by 0.1% as per CBO estimates, and the level of real GDP in the first quarter of 2019 was expected to be reduced by around 0.2%. So the past shutdown's impact on US stocks, meanwhile, has been quite muted, or rather not been concerning. The S&P 500 has fallen by an average of 0.4% in the week before a shutdown and gained a total of 0.1% over the length of all shutdowns since 1976. Data also suggests that market volatility during shutdowns has remained way below what was seen during the 1987, 2008, and the most recent 2020 market meltdowns. In the most recent shutdown, which is in early 2019, despite a shutdown, we saw stock markets still posting positive returns, and a lot of it was driven by the Fed's turnaround then on policy rates, as against now the current backdrop in 2023 of higher rates, higher inflation, although it's slowing down a bit, higher oil prices back again, coupled with the risk of a shutdown, which could lead to spending cuts, dampening the economy further. And as always, equity markets will be quick to pick up the cues, which, not surprisingly, is already reflecting in the current market moves. The MOVE index, which measures bond market volatility, rose 3.8% during the shutdown in 1990 and 7.2% in the 1995-1996 shutdown. However, the volatility gauge fell 12.6% and 14.8% during the shutdowns in 2013 and 2018-2019 respectively. This was sourced from Morgan Stanley. So while shutdown could lead to volatility, it could also provide selective opportunities for investors. Last, importantly, but definitely not the least, long term and regular systematic investors should be reassured that equity markets have delivered healthy returns despite such events. The bigger risk remains of how high and how long high rates remain in force and other concerns emanating from the current high oil prices. As for the shutdown, this too shall pass. If you like the video, then don't forget to press the like button, subscribe to my channel for more such videos, and don't forget to write your comments on any feedback or topics you would like to be covered going forward. Thank you and wish you all a great day ahead.